Politics are proving to be a dominant driver of market movements again this week, affecting everything from the oil price to company stock market debuts. The price of oil is on the rise after the number of US rigs drilling for new production was cut last week, and we can expect that trend to continue once US sanctions against Iran's crude exports take effect from November. Talking of sanctions, President Trump has upped the ante against China yet again, this time by trying to encourage the likes of Apple to bring their production lines back into the US. In a weekend tweet, the US president seemed to suggest that Apple could keep prices down and customers happy and cut its tax bill to zero if it moves its manufacturing process to the US from China. Quote, "Make your products in the United States instead of China. Start building new plants now. Exciting," he tweeted. It's fair to say that Asian markets, though, are anything but excited by Trump's threats, as they faltered for the 8th day in a row. After seeing a 3.5% fall last week, marking their worst weekly performance since mid-March, Asian shares started the week in the red again. The fact is that the argument is far from over, and the threatened trade wars are now impacting on individual stocks. Chinese company Geely is reportedly delaying the listing of Volvo cars due to valuation concerns while we're in the midst of a threatened global trade war. Geely believed it had the backing for a flotation valuing Volvo cars at $30 billion, but worries that investors, many of whom were expected to be Swedish pension funds, would see the share slide south straight after the float. That has meant it's put the brakes on the planned listing, the FT has reported. Staying with individual stocks but closer to home, it's retailers here that are still feeling the pinch. It's a busy week for the retail sector as we get results from the likes of JD Sports, Dunelm Group, William Morrison Supermarkets and Primark owner Associated British Foods. A fall in sales during the summer heatwave has been noted by the British Retail Consortium, which has also predicted that a further spell of decent weather in September could cost the UK's non-food retailers up to £80 million a week. If weather-related woes are starting to sound all too familiar, that's because they are. Previous research by the Met Office has found that nearly half of UK retailers say the weather is among the top 3 external drivers of demand. Hence all those profit warnings after the beast from the east blanketed most of the country in snow earlier this year. And now the latest batch, due to one of the hottest summers on record. Couple that with a climate of cautious consumer spending, and you can see why these retailers have suffered the perfect storm. You only have to take a look at the difference between food and non-food retailers, and the retail divide is plain to see. Since the start of the year, shares in UK food retailers have risen 30%. That's good news for shareholders in the likes of William Morrison Supermarkets, which releases half-year figures on Thursday, but shares in companies in the wider retail sector, which includes fashion and homewares, have seen a 10% fall overall. However, a lot of that would appear to be at odds with the latest figures from the Office for National Statistics. Already this week, we've had news that the UK economy is still growing, and better than anyone probably expected. The latest set of data shows that retail sales have performed well, boosted, it says, by the summer weather and the World Cup. So while the likes of Debenhams and its fellow department stores, along with pound shops and homeware retailers, have felt the chill winds, that's not the case across the entire sector. Retail has become very much a game of two halves. Monday's figures show that UK GDP grew 0.3% in July, and over the 3 months the economy expanded by 0.6%. That's above economists' forecasts. Economists at Pantheon Macroeconomics had penciled in growth of 0.1% in July, and their rolling 3-month growth rate was slightly underestimated too at 0.5%. The figure was 0.4% in June. It's good news because it would appear the UK is looking in much better shape as we enter the crucial stage of Brexit talks, and that seemed highly unlikely even just 6 months ago. Even the construction sector, which has found itself in a hole of late, saw a 3.3% rise in the 3 months to July. Needless to say, economists are upbeat about the latest numbers on the UK economy. That may be a little too late, though, for the likes of Debenhams, which has seen its shares slump from the heady heights of 202 pence back in May 2006 to just under 12 pence today. Already in the middle of a turnaround plan, Debenhams bosses have called in KPMG to look at all possibilities, including a company voluntary arrangement, which so many of its retail sector counterparts have already succumbed to. While we're on a less upbeat note, it's worth mentioning that this is also a week of sombre anniversaries. We have the 17th anniversary of 9/11, and it's also 10 years since the collapse of Lehman Brothers and the ensuing credit crunch that led the country into recession for a good 5 years. Looking forward to other notable dates, it's now fewer than 200 days before the Brexit deadline, and sterling has been seeing something of a rally on hopes that a positive end is in sight. The latest report is that the US has said its trade talks with the EU are moving along constructively. The US said its trade representative and the EU's Commissioner for Trade had a constructive meeting on Monday. The ministers will meet again over the coming months with a view to finalising new trade arrangements in November, it said. All eyes will be on the strength of sterling, of course, as Brexit uncertainty continues. After regaining some ground last week on the back of unsubstantiated reports that the EU and the UK were close to reaching an agreement, it fell back a little way, but has since rebounded again this week. That strong economic data first thing Monday morning certainly helped, as did a report that Michel Barnier thinks a Brexit deal with the UK is realistic and possible within 8 weeks. Bloomberg said the EU's chief Brexit negotiator, speaking at a conference in Bled, Slovenia, said both sides needed to reach an agreement by the start of November. While all this is going on, it's also worth keeping an eye on gold as the pound regains ground. Gold futures crept modestly higher on Monday as the dollar weakened on the back of a rally in the pound. That shone a favourable light on the dollar-denominated precious metal, enabling it to make some headway, finally, after posting 3 weeks of losses. Well, that's all for this week. Thanks for watching.